Hi everyone, I'm Debbie Roberts, owner and financial advisor at Property Apprentice. Welcome back to another episode of the Week in Review. This week we'll have a look at some of the budget announcements. We've got data revealing that nearly half of all first-home buyers are rewriting the rules of market entry. Meanwhile, an evenly split Reserve Bank left the OCR on hold for now. We'll also unpack how affordable it is to be a tenant in New Zealand and take a serious look at how age and gender are impacting KiwiSaver balances. There's a ton of insight to get through today to help you to navigate these numbers with more confidence. So grab a cuppa, get yourself comfortable, and let's have a look at the data. Topic number one from Stuff on the 28th of May. This was released in the morning on the day of the budget. So everything that they already knew was going to be in the budget announcement for budget 2026. The government announced a target to reduce the public sector workforce to 1% of the population, affecting roughly 8,000 jobs, in order to save $2.4 billion over 4 years, with a heavy emphasis on digitisation and artificial intelligence. Economists and opponents note that these public sector job cuts will place significant contractionary pressure on Wellington's already struggling regional economy. Social housing tenants will see rent obligations increase from 25% to 30% of their income, a move expected to save the government $387.5 million over 4 years, while the state continues to subsidise the remainder directly to landlords. The baseline funding for Health New Zealand will increase by $1.37 billion annually, alongside a specific $180 million boost for healthcare infrastructure for the Otago Central Lakes area, and a new $100 million allocation was made for constructing dual courthouse facilities in Rotorua to replace defective existing infrastructure. To help industries transition away from gas, the Crown is backing up to $1.2 billion in bank loans, guaranteeing 80% of eligible loans to secure lower interest rates for businesses. The newly established Ministry of Cities, Environment, Regions and Transport is receiving initial operating funding to review the Utilities Access Act and refresh infrastructure corridor codes. So my thoughts on this: for property investors, pre-budget announcements were all about reading between the lines to spot the regional demand shifts. The 8,000 public sector job cuts mean that we need to be incredibly cautious with the Wellington market right now, as downsizing tenant pools will naturally soften rental demand there. However, look where the capital is actually flowing. We see a $1.3 billion baseline boost to Health New Zealand, a specific $180 million injection into the Otago Central Lakes infrastructure, and $100 million for Rotorua's courts. This tells you exactly where long-term stable employment is being created. Pumping money into regional health and infrastructure means a guaranteed influx of professional workers who need quality housing. If you target your investment strategy towards these high-growth infrastructure hubs rather than bureaucratic centres, you could be positioning your portfolio to ride a wave of government-backed structural growth. But remember, it's all about the fundamentals and making sure that you're buying a property that suits your financial position, not just where you see potential benefits in the future. So let's have a look at some of the shift in social housing, where tenants' rent obligations are lifting from 25% to 30% of their income. While the headlines are focusing on the political fallout of this $387.5 million savings measure, as an investor, you need to focus on the fundamentals of this. What the government's trying to do is transition these tenants away from social housing and into the public renting sector. So this is not only going to save New Zealand taxpayers a considerable amount of money, because, the private rental market is a lot more sustainable and certainly cheaper for the New Zealand taxpayers than having the government provide rental properties, but it's also going to help the social housing tenants to transition from social housing into the standard rental market. And if you're an investor partnering with community housing providers or operating in that social housing space, this is a clear green light. It shows that even when the government is aggressively cutting back office costs, they are fiercely protecting the financial viability of housing partnerships. They're shifting some of the fiscal weight to the tenant to balance the books, but the total market rent flowing to the property owner remains completely intact and government guaranteed. And it underscores just how safe residential real estate can be as an asset class. The government will literally rewrite fiscal policy to help ensure that landlords get paid for the service that they're providing. Topic number 2 from Good Returns on the 27th of May, divided RBNZ keeps the OCR on hold. The Reserve Bank of New Zealand kept the official cash rate on hold at 2.25% on the 27th of May, but they updated projections, which indicate a likely increase to 2.5% in the September quarter, with the potential for an even earlier hike, depending on what the data looks like as it comes in. The central bank expects the official cash rate to eventually peak at 3.3% by the December quarter of 2028, and then to remain flat at that level till mid-2029. A deep split within the Monetary Policy Committee was revealed as 3 external members pushed for an immediate hike to 2.5%, and the other 3 members chose to hold it, which meant that Governor Dr. Anna Bremen was the casting vote who chose to maintain that hold at 2.25%. Commercial bank economists are forecasting a much steeper tightening cycle, with BNZ predicting a rate hike as early as July and an ultimate OCR peak of 4% by May 2027. Annual inflation is projected to reach 4.2% in June and peak at 4.3% in the September quarter, before dropping back within that 1 to 3% target band by mid next year. Economic growth forecasts have been significantly downgraded, with the central bank projecting 0 GDP growth for the current quarter and minor expansions of 0.2% and 0.5% later in the year. Basically, the main reason for this is the conflict in Iran. So the unemployment rate is now projected to climb and peak at 5.4% by the June quarter, holding at that elevated level for a full year before they're projecting it to start gradually easing. So my talking points on this, the mini upturn that we've been tracking is starting to look a little bit fragile. Basically, since this conflict in Iran, it has stalled the economic recovery that we were seeing in New Zealand. So it hasn't stopped it completely, it's just slowed it down. While we've seen 3 months of modest gains in the property market, that 0.1% rise in April, not exactly a sign of a roaring recovery, is it? It's more like the market's taking a breath. And what is really telling is that regional split. Auckland and Wellington are pretty flat, while Christchurch and Dunedin are still showing some really strong resilience. The shift towards 2-year fixed rates, as the majority of mortgage holders appear to be fixing at the moment, is quite an interesting behavioural change. So people traditionally in New Zealand have chosen the 12-month rate. So they're moving away from those shorter term rates into longer term ones. My advice is the same as always. Talk to your mortgage advisor. It could be a good time to look at splitting your mortgage. At the moment, interest rates are well below the long-term average, even at the 5-year rate levels. So worth having a look at to see whether it's a good opportunity for you to split, potentially refinance to a different bank to get better interest rates. Look at the opportunities that are available there. In a flat market, your best investment isn't always to rush into a new property, although it can be a great opportunity for those strategic buyers. It can be, the best strategy for some people could just be debt reduction. Focus on reducing your mortgage by paying off extra into your mortgage if you can afford that. Every dollar that you pay off right now is a guaranteed tax-free return. And if you can do that while interest rates are below average, that is certainly going to help you when interest rates increase further over the next little while. And so don't wait for the market to move for you. Take care of your own numbers and talk to your mortgage advisor to get some good guidance there. Topic number 3 from Stuff on the 28th of May, nearly half of all first home buyers are skipping the 20% deposit milestone, highest on record. The proportion of first-time buyers entering the property market with less than a 20% deposit reached an all-time high of 47% for the year ending March 31st, nearly doubling the 26% rate recorded when tracking began in 2014. Total low deposit first home purchases more than doubled over the last decade, growing from 6,328 buyers in 2015 to 13,990 buyers by 2025. The surge is largely credited to flat property prices, making entry easier for first home buyers, combined with the Reserve Bank's easing of loan-to-value restrictions, those LVR restrictions, which raised the bank lending cap for low deposit owner-occupiers from 10% to 25%. This regulatory relaxation has allowed a greater number of buyers to purchase a home independently, significantly reducing the market's reliance on parental financial support, the good old bank of mum and dad. While stagnant prices lower the immediate danger of buyers falling into negative equity, economists warn that low deposit borrowers can face greater financial exposure due to low equity fees and premium interest rates. Although the Reserve Bank notes that systemic risk remains low, with high LVR loans comprising under 10% of total outstanding mortgage debt, property experts stress that individual households must ensure their budgets can absorb potential mortgage payment shocks if interest rates continue to climb. My thoughts on this are that seeing first home buyers taking up nearly half of the low deposit space isn't just a statistic, it's a sign of early market renewal. For anyone who's been worried about that generation rent narrative, this data proves that the Kiwi dream's very much alive and, more importantly, attainable. But like the article says, you do need to stress test that you can afford interest rates at a higher level. So, talk to your mortgage advisor, make sure you're not overextending yourself, and make smarter decisions. This is a buyer's market, and it's a really good opportunity for people with less than 20% deposit to purchase a home before house prices start to climb further, and also to give you the opportunity to lock in your interest rates before they increase further as well. So it tells us that these buyers aren't desperate to just get anything. They are being discerning with their purchases. And as an investor, this is really good news for your long-term exit strategy as well. Because when you eventually go to sell, if you choose to sell in the future, then you could potentially have a good pool of buyers available at that point too. If you're getting value out of this podcast, please open your Apple Podcasts or Spotify app right now and hit that follow button. It's the number one way to help us help first home buyers and property investors gain better access to quality content. And if you want to learn more about investing, join me at one of our events called How to Succeed with Property Investing. These online events are free, and we focus entirely on helping you increase your knowledge about the property market so you can make smarter decisions with your next purchase. As a financial advisor and experienced investor, I'll help you to navigate the current market with more confidence, which will help you to make smarter decisions. We're live, online, and independent. We don't sell property. Topic number 4 from New Zealand Financial Advisor on the 25th of May, the 30% rent rule was a warning, now it's policy. Long-standing housing affordability benchmarks are under scrutiny, with 2023 census data revealing that 26.5% of New Zealand renting households spent 30% or more of their income on rent, and nearly 13% commit over half of their income on rent. Traditionally, 30% has been the benchmark for rents as to what's affordable. 30% of your income or less would be considered to be affordable if you were a tenant. Market data from TradeMe shows that the national median weekly rent rose for the first time this year in April 2026, climbing to $625 amidst a 5% drop in rental supply and an 8% surge in tenant demand. Comes back to that good old supply and demand thing, doesn't it? Economists point out that the 30% rule is highly dependent on income distribution. A low-income household paying 30% is left with unsustainably low cash reserves for everyday essentials, whereas high-income dual earners can easily absorb a much higher ratio. Data from financial mentoring services show that their clients face a median rent-to-income ratio of 36.68%, with over half operating in a weekly budget deficit, highlighting that tightening squeeze on the lower end of the market. Look at the latest Trade Me data. Rental supply is down 5%, while demand is up 8% across the board in New Zealand, which pushes that median rent right back up to $625 a week. What this tells us is that the fundamental demand for roofs over our heads is continuously outstripping supply, which brings to mind the fact that a number of economists that we've spoken to recently have mentioned concerns about the fact that we're just not building enough properties in New Zealand. As residential property investors, our role is to provide high quality housing supply to meet this clear structural shortage. For your portfolio, it reinforces why targeting stable, mid to higher income dual earner households could be a smart play. However, there's also really serious demand for people in those lower income brackets as well. And oftentimes the rental returns can be stronger in those areas as well. So you've got to purchase the property that's right for your financial position and long-term goals. When you focus on providing top-tier rentals in regions where local economies and wages are strong, your yield might be protected by the sheer law of supply and demand. But if it's a strongly negative cash flow position, it might not be the best investment decision for you. Topic number 5 from New Zealand Herald on the 26th of May, the average KiwiSaver balance for your age. New data from the Retirement Commission shows the average KiwiSaver balance has reached $41,286, marking an 11.3% increase since 2024 as the scheme approaches its 20th year of operation. A significant gender savings gap persists across the board, with men averaging $47,452 compared to women's $38,202, an overall 24% disparity that widens to 36% for those in the 56 to 65 age bracket due to the gender pay gap and also career interruptions. You know, we still are in a society where the majority of stay-at-home parents are the mums. While 1/3 of accounts still hold less than $10,000, the percentage of larger balances has doubled, with 15% of members, that's nearly 450,000 people, now holding over $80,000. Active contributions remain heavily tied to your income, with 70% of all members contributing regularly, which spikes to 90% for employed individuals earning over $50,000 a year. The Retirement Commission emphasises that because workplace-linked savings naturally reflect income inequalities, New Zealand Super remains an indispensable foundation for low-income and part-time workers who can't accumulate substantial balances. Senior New Zealanders are increasingly treating the scheme as a long-term wealth strategy, with the number of members over the age of 65 choosing to keep their funds inside KiwiSaver growing to 206,000 people. This KiwiSaver data is a real eye-opener for anyone focused on wealth management. It highlights exactly why residential property serves as such a great financial equaliser. And while it's fantastic to see balances growing with a doubling number of people holding over $80,000, the reality is that a $40,000 or $80,000 balance at retirement isn't going to fund an abundant lifestyle. Like, you're not going to have a brilliant retirement on that level. It might hopefully keep you off the breadline, but it's not going to give you much choice in retirement. So you can't save yourself to wealth. You need to invest to strengthen your financial position. Getting good advice around KiwiSaver is an important part of your overall financial plan. And that's why all clients of ours get KiwiSaver advice as part of their plan. Okay. So we cover off everything for our clients to help make sure that you've got all aspects covered. And look, it's a fantastic time to be in the New Zealand property market, regardless of whether you're a first home buyer taking advantage of those lower mortgage costs with prices being stable and interest rates still being below average, or whether you're an investor who's navigating through these shifts in the current market and trying to close your ears to the negative narrative that's in the media about, property values dropping here, there, and everywhere, or whatever. Keep your eye on the goal and remember that property investing is a long-term strategy. But I want to hear from you. Infrastructure investments in your region making you look at property differently? Or is the media noise starting to make you feel more nervous about investing in property? That's the dog's tail that you see there. Welcome to our Chief Cuddle Officer. She just jumped off my lap. But, let us know what you're seeing in your area. Has this KiwiSaver data inspired you to diversify more, increase your KiwiSaver contributions, or look outside of KiwiSaver for investments? Does the things that we've been talking about in these podcasts, has that given you a bit more clarity about whether or not it is a good time to buy property? Just remember, we don't sell property, so we've got no conflict of interest here in talking about property investing as a pathway to create wealth. Certainly, property does give you leverage that investing in the share market or KiwiSaver doesn't have that same benefit. And eventually, we are going to get capital growth again. It's just, this is a normal stage of the property market that we're in at the moment. Okay, so remember, keep your eye on the horizon and make sure that you build a strategy to suit your financial position and your long-term goals. And if you want help with that, you know where to find us. Go to propertyapprentice.co.nz and get in touch. If you haven't been to one of our free events already, great time to register for one of those online events. Doesn't matter whereabouts you live in New Zealand, you can jump online, ask me as many questions as you want to, and I'll answer as many as I can, time permitting. So go to propertyapprentice.co.nz and I'll look forward to seeing you in one of our next online events. So thanks for listening and I'll see you next week. Hey there, want to stay on top of the latest property news and trends? Subscribe to the Property Apprentice podcast for weekly updates that will help you to navigate the market like a pro. We cover everything from insider tips to expert interviews, so you'll always be in the know. And don't forget to ring the bell and hit that subscribe button here on our YouTube channel for even more helpful content to boost your property journey. Check out the link in the description to subscribe to the podcast, and we'll see you in the next episode. Happy investing.